Welcome back to the What You More podcast. I'm your host, Quinton Harris. You're dialed in for episode 260. It is great to be back in the studio after taking last week off. Sometimes you take like 1 week off. It feels like an eternity, but nonetheless, glad to be back. So, hey, in this episode, no government, no employment data. No problem. Hey, we're going to take a different approach to today's podcast, take a look back at the 80s and see what history shows us about today's housing insight. All that and more in this episode of What's Your One More. All right, so welcome back. Yeah, so let's talk a little bit about this, what we're seeing happen in the market right now from the 80s moving forward. And the reason I want to say is take a look back at the 80s, right? Because there's a different trend going on at that time. We had higher rates. It's starting to sound familiar, a little elevated inflation coming off of that, the reaction of the markets and the Federal Reserve. But I want to take a big look at America's homeowners and how I think they're more locked in now than they've been since the 1980s. Now, I'm not stumbling upon any revolutionary thought process here. We know that, right? We've talked about the lock-in effect. Matter of fact, I had to go back into our show episode. This is episode 260. Pretty pivotal episode for us. So over 250 episodes, 260. It's a big one. 300 was always a number. Charlie and I said if we could get to 300, look out. So we're on our way there. But this episode in particular, I had to go back almost, I think 2 years is what I saw on there, almost 2 years. And we're approaching our 3rd year anniversary here. And 2 years ago, we were talking about the lock-in effect. And if you go back to some of those episodes, it wasn't just one, it wasn't just two, it was 5 episodes I've been talking about the lock-in effect. And I had the old pinwheel on there and how many mortgages were locked in at 3%, 4, 5, 6, you get the picture. We even started putting 7% on there because there's some trade-offs that happened. We started looking at trends where people were basically refinancing their 3% mortgages and putting them at 6.5%, 7%. We see there's demand in the market right now as far as pent-up buyer demand. We've shown significant data sets that suggest that, but the market is in this stagnant moment right now where it's almost like who's going to blink first, the seller or the buyer? Meaning, is the price a little elevated? Is the seller going to come down? Is the buyer going to pay that price? Are rates going to come down to allow them to afford that? Are we going to get more closing cost contributions from sellers? Like, what is it? Someone's going to blink, something's going to happen. One of those factors are. But where we are right now is that in this lock-in effect moment that we're in, there are people that are stuck in their homes. You know, one reasons Americans are moving less, obviously, is due to the rise in mortgage interest rates. And, you know, and as we've seen these rates kind of go up, the trend's gotten worse. But after a decade of non-zero rates, though today's stuff will still feel like there's like a shock in the system, they're lower than they traditionally were. Selling now would mean trading your low monthly payment for something far pricier. And so the result is a market freeze. And that's what we have right now. It really is looking to who's going to blink first. The market freeze is buyers wait for rates to cool down. And sellers remain anchored in their old mortgages and a little stubborn, if you may. Now, let's call it what it is. They're stubborn in that old mortgage rate. You know, they're very comfortable in these 2s, 3s, 4s, and even 5s. You get comfortable in that payment. And as we know, the job market is not drastically improving. Some could say it's deteriorating. I wouldn't say it's a landslide yet, but it's not improving. It's not getting better. Now, we have no new data to suggest that, but there's a lot of trends that are suggesting that, right? So we're kind of hypothetically speaking. But with the job market where it is, people are very comfortable in their payments and they don't want to change. So that's creating this freeze that's going on there. And then last year, the existing home sales, they hit some of their slowest paces that they've seen in nearly, 3 decades, right? Don't get me wrong, the market's still moving, but it suggests the trend that I'm talking about. And so we've got a graph on our YouTube channel. And if you're not a YouTube subscriber, please go in and check us out at What's Your One More with the number 1. Subscribe, smash up the like button. We'd love to have you guys on our channel. More importantly, love the feedback you guys give us. Love the questions, the Q&A. You guys do a great job throwing stuff at us, and we greatly appreciate it. But if you're listening to this on Apple or you're listening to it on Spotify, transition over to this graph. My producer's going to put in the screen here, but it's significant when you look at this lock-in pressure. So in the graph, the red represents like these higher lock-in pressures that are taking place. And then the blue shows where people have basically refinanced or upgraded their home, but they took advantage of the low lock-in pressure, right? And I think homeowners are likely to move and refinance those lower rates, which is what you're seeing right here. Whereas they get stubborn, these higher ones, then they kind of get a little worried and they hold on. And it's not, for me, it's not ironic that the job market is a delayed reaction of stubborn rates and a delayed reaction of higher rates, which are tightening of fiscal policy. And you kind of see this pattern happen here. So if you look back at the 80s, specifically 78 to 83, this massive lock-in pressure, far greater than what we're dealing with right now. Longer term, also a significant more amount of people, and the rates were higher, right? Rates are, in this case, we're up in the the high eights, right? But if you take a look over here where we are hanging out and the things that were going on, in some cases are 18% mortgages back in the 70s too. But it shows the population and it shows the stubbornness taking effect here. It's a great graph, and for me, the source from Freddie Mac on here suggests that history might be repeating itself, and I don't think that comes as any type of epiphany, right? But what I do want to point out is look what happened after 83. Look at that land. Look at that huge. You could call it a 2-to-1 ratio of people refinancing or buying another property, getting out of their mortgage and getting into a new mortgage on a new property. Look at this from 83 all the way to really, I mean, you could argue 1998, 2000-ish. I mean, my goodness, that's before the dot-com bubble. You literally almost had a 15-year to 17-year run of very good transactions taking place. And it's not even close. So then I asked myself, could that be what's in the forecast? Could we be on the horizon of that? I think we are. We've been talking about that for some time now. And I think when I saw this graph, I was like, whoa, this is exactly what we've been forecasting and predicting, and it's already happened. And it looks like it's about to happen again. Can I say the next 60 days? I don't know. 90? I don't know. A lot of this is dependent on the Federal Reserve policy. A lot of it's dependent on job data that we're not getting, right? We need to see where that is. But I will say this, regardless of any of that, you're going to see this happen because in 83, 84, 85, 86, all the way through 98, the job market, it was up and down, right? It wasn't consistently awesome during that time. But where I'm going with that is inflation also was consistent during that time. You didn't have crazy runs of that during there because you're coming off those high ends of it where you're trying to impact it with Federal Reserve tightening policy. But the result was a tremendous amount of homeownership taking place, a tremendous amount of refinancing. You're refinancing your debt down and then buying and upgrading homes and properties. We've been saying this is going to happen when that cycle hits. Here's a 15, 17-year proof that it's going to happen. I think this is very interesting, and I think this is things to come. I also think that we've got buyers sitting on the sidelines that are going, I'm just waiting for lower rates. I'm waiting for, these prices to come down. Now, we've done way too many episodes on the ideology of why those prices aren't going to come down, at least crash, as people say. But what you're seeing is an opportunity of this pent-up buyer thought process that's going to happen. Population now is far greater than it was during that time. And the actual homeowners themselves, if you look at the housing, population as a whole, is significantly higher. And we don't have the inventory to basically supply that, right? There's not enough inventory there to fill that appetite. What does that look like when these buyers get to the start line and say, I'm ready to go now? What does that look like with home prices? Do you think they stay where they are, or do you think they're going to go up? Let's just say they go up 2%. They're still 2% higher than what they would be today. So if I'm a buyer, I'm going to think about today's market, and I'm going to think about how I can get ahead of the curve. That's something we talk about in real estate all the time. Being ahead of the curve, not pricing to the curve. Meaning that if you could be ahead of the market rush, you're not paying the curve prices as they go up. And that's something to consider on here. And again, this graph does a wonderful job of illustrating that and putting it right in layman's terms for you.
Today's episode is brought to you by Texana Bank Mortgage. They're coming to the table with a revolutionary product. It's called REMLO, Real Estate Mortgage Loan Originator. And what they are doing is they are taking real estate agents and they're taking loan officers. And for the first time in history, they're putting them together under one umbrella. They're actually taking two industries right now that sit on top of each other, and they're putting them together and backing it by a full-service bank licensed in all 50 states. So imagine this. You're not just an agent anymore. You're a full-service agent. You're the single trusted point of contact for your client in this entire process. You're seeing the loan and the home search front to end. It's going to change the dynamic of real estate and mortgage lending together. Now, if you're a real estate agent, I want you to do me a favor. I want you to go to askaboutremlo.com. That's askaboutremlo.com. Because what you're going to find there are significant details about this program, how to enroll, and how to gather more information. So if you're ready to adapt and thrive, go to askaboutremlo.com. That's askaboutremlo.com.
All right, the second thing I want to talk about on this podcast, let's talk about something that I thought was really interesting here. What about the S&P 500 right now? Now, I don't claim to be any type of financial advisor or guru of this, but I know math, right? And I do understand the principles of the stock market as well as S&P 500. And when you look at the percentage of increase over the last 10 years of the S&P 500, it's astonishing, right? We're seeing gains and roars in the market that, we've never seen before. And I'm going to put another graph in our YouTube channel again at What's Your One More with the number one. But man, this one jumps off the page. So if we go back to this 10-year run for the S&P 500, literally going back to 10 years ago, it's almost a 250% increase in the S&P 500. It is incredible when you take a look at this. And I don't think like, okay, so here's the thing. When you look at the sales per share, they're up 79%. When you look at the dividends per share, they're up 85%. If you look at the earnings per share, they're up 156%. But the actual index is up 250%. It's far exceeding all of those fundamental reasons for it to increase. I'm not saying there's a bubble there. I'm not saying that it's going to crash. I'm just saying that when you look at that, when I hear people worry about real estate, and I use these two things in correlation together because you have the equities market and the housing market, right? You could throw the crypto market in there as well, right? As far as the markets themselves. And we could do a whole nother one on crypto and what's going on over there. If you're into that, man, kudos to you. You're seeing a great run right now. But a lot of these two runs go hand in hand, I think, the equity market and the crypto market, as far as the bullish run that's taking place right now. It isn't always like that, but right now it seems to be trending the same way. And so there's been a lot of government favor regulation in crypto, so you're seeing the windfalls of that. You're seeing a lot of AI jump into the equities market, and on the NASDAQ side, you're seeing the wins there. But let's take a look at this. I say the following things. When people talk to me about the concern of real estate going up and that it needs to come down, it's mind-boggling to me we're not entering the same thing with these contexts of the equity market. I mean, to me, I think there's a bigger concern of the equity market rising with no fundamentals to support it at the rate in which it's rising, more so than I am housing. At least with housing, you're seeing moderate gains. These are significant, unprecedented gains we're seeing in this market. So I say this. If you're in your 401k, you're probably excited as can be, and you're like, this is great, I'm winning. Why don't you want to be winning in real estate? Why don't you want to be winning in the housing market? Get into that. Get involved, because you're going to see run-ups happen as we come off the backside of this lock-in moment that we've been in. The history showed us happened again in the 80s. For almost a 17-year run, we're going to see another run here coming out of this. And get ahead of the curve. Beat the market, beat the curve, get ahead of it. It's a win that you can take advantage of right now that, quite frankly, most people tend not to look at and just wait until the curve's here and they're buying at higher price points, complaining about that. So take a look at that. Again, go to our YouTube channel, check out the stuff that Charlie's putting on there. All right, final thing I want to talk about. Speaking of mortgages, right? My wheelhouse right here. Recently, there was a lawsuit filed in the state of Tennessee claiming that companies are data sharing through a platform called Optimal Blue. Now, for our lenders that listen, you know exactly what that is. But for our subscribers that listen, they're not familiar with the lending world, whether you're a real estate agent, this may be a new term to you, or just a consumer guy. But Optimal Blue is a pricing engine. It's an engine that most every lender uses. Now, there's competitors, right? There's other people that use pricing engines that are not Optimal Blue. But anyway you look at it, lenders use a pricing engine because there's so many data sets and factors that go into pricing out an interest rate for a borrower. You kind of need some sort of collective system that filters all of the rate sheets in, all of the loan level price adjustments, credit score adjustments. You get the picture. There's a lot of adjustments that take place. So the largest one, the nation's largest one, is owned by ICE, Black Knight, if you may. And we're all familiar with who Black Knight is. But Optimal Blue is one of the largest. And so there was recently a lawsuit filed on October 3rd in a U.S. district court in the Middle District of Tennessee against Optimal Blue and 26 of the largest U.S. mortgage lenders in the country. Now, again, there's more than 26 lenders that use this platform. But the lawsuit claims that because there's data sharing going on in this platform, meaning that lenders can subscribe to a piece of Optimal Blue that shares interest rate information. And what it shares is market pricing of your competitors. Now, it doesn't tell you that competitor A is pricing at this and competitor B is pricing at that. C, you get the point. That's not what it's doing. It doesn't tell you where all 26 of these guys or who each 26 person are pricing at. So what it tells you is where they're pricing, right? So you may get an anonymous report with 26 people on there, and it's a lot more, by the way. But you may get it with 26, and you can get it down to your area. You can get it down, in this case, into Tennessee. You can get it in Jacksonville, where I'm broadcasting from, or you can get it nationwide. But these reports are to keep lenders in line with one another so that you're not way out of the market in pricing versus another lender. Now, anybody could go online and look this up. Like, I could go to Rocket, look up their rates right now, go to Navy Fed, look up their rates. The list goes on. You get the point. Like, I could go Wells Fargo, I could go to a lot of these lenders and look them up. But what this claims is that the data sharing since 2019 was enabling these 26 lenders to orchestrate a price fixing scheme So think about what I'm saying here. This lawsuit is suggesting that people that purchased homes and refinanced homes from 2019 moving forward claim that their costs were impacted by this alleged conspiracy of data sharing, and that the plaintiffs are seeking undisclosed damages and punitive injunctive relief to dismantle the alleged price-fixing scheme. Due to the nature of residential mortgage markets, there are likely millions of people impacted, this lawsuit states. Now, I don't disagree. There's millions of people that refinanced and purchased during that time. Impacted? I think this might be a little bit of a reach here. I'm not saying there's no merit involved in this, right? I think that if someone could get into the weeds of this and suggest that of these 26 lenders, let me just kind of read you who they are. They're big-time lenders here. Wells Fargo, United Wholesale, you've heard us talk about them a little bit. Rocket, JP Morgan Chase, Loan Depot, Bank of America. I mean, the list goes on and on. U.S. Bank. We're picking the rule of deepest pockets here. That's what we're doing. We're going after the rule of deepest pockets. You got Cross Country Mortgage, Penny Mac, Movement Mortgage, CMG, like I said, Citibank, list goes on, Flagstar Bank, it goes on and on and on. But basically, essentially saying that they're price fixing, meaning this lawsuit's claiming that they were able to maximize the amount of profit they made on each loan by sharing interest rate data of what they're doing amongst their competitors, right? Amongst the other people. So by gauging the fact that if I knew lender A, B, and C were charging the borrower X amount of dollars or putting in a margin of X amount of dollars, I too could do that. And then my service would win the battle, not necessarily my rates, and I could maximize profit. To me, that's just business. I don't understand how that's a significant punitive injunction relief damages. List goes on and on. This seems a little ambulance chasing. I hate to say it like that, but I mean, essentially saying that the spreads on the mortgage were 9.6 basis points higher than the baseline. Let me put that in perspective for you. This is how frivolous this kind of sounds to me. Is that 10 basis points is 0.1%. And that's not to the interest rate. That's to the profitability on the back of the loan. So if you're doing let's say, I'm trying to give an example here. Let's say you're doing a $100,000 loan. We're literally talking about $100 here. We're not talking about thousands of dollars. Now, you could multiply that times millions of people, but the reality is lenders give more in credits than that 9.68, that lenders reduce their margins by more than that every single day just to make a deal work. This seems like a very frivolous and very ambulance chasing scheme here. I don't see how this impacts anything on here. And I think once it gets to the court of law, they'll figure it out. But it does bring to light this. Here's what comes from this. Is data sharing a bad idea when it comes to the fact of increasing profitability if it's at the risk of consumer harm? That I do believe. I believe that in a world where margins could go, back up to 125, is finding a way to get those to 150, which is basically 1.5. Well, yeah, that's far different than 0.1, right? But in a world right now where margins are compressed and lenders during a lot of that time were laying people off and trying to find a way to maintain keeping people employed, and in some cases still doing that today, I don't think that's a bad idea. I actually think that's pretty smart. And at the end of the day, what this lawsuit shows is I think the consumer actually wins. The consumer's actually winning. They're not being there's nothing harmful about it, because it's pretty significant. It's pretty insignificant, the amount of money there at $100 in that example versus these millions of dollars that they're frivolously throwing out here. So just thought I would share that. This is sometimes where lenders get a black eye. This is sometimes where this stuff can kind of get blown out of proportion, because at the end of the day, this stuff happens all the time. There's nothing regulatory wrong about doing it. There was no personal information shared. It was really business insight shared amongst lenders anonymously. I can't stress that enough. Anonymously, that's very important. And I don't even know, they just chose 26 lenders, right? I just think they picked lenders out of the air that did the most mortgages during that time and threw them in here. I don't think there's any rhyme or reason as to why they're doing that, because Optimal Blue services over 3,500 lenders. So I thought that's pretty interesting to only choose 26. Again, rule of deepest pockets. So that being said, guys, it's great being back in the studio. Look forward to the next episode of What's Your One More. If you aren't subscribed to our YouTube channel, please check it out. What's Your One More with the number one. And also, if you're a listener and you don't like visual stuff, go to Apple or go to Spotify. We're on both platforms. We'd love to have you as an avid listener to our show. Till next time, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.